everyone to this webinar on ALM, liquidity, and touching on Basel III. ALM has always been one of the most important areas of all financial institutes and is usually overshadowed by Treasury and market risk. In today's webinar, I'm going to try and kind of demystify the functions of ALM. Also, I'll give a brief insight into what liquidity risk and liquidity management is, as well as the new regulations around liquidity under Basel III. As you can imagine, 1 hour session is not enough to cover the entire Basel III. So I'm only going to be focusing on liquidity and liquidity requirements under the new regulation. There's a heap of stuff in the capital portion, which again is we don't have enough time to cover it. So that's the sort of the content we're going to go through. So ALM, roles and purposes, liquidity risk, importance and management, Basel III, and we'll take Q&A at the end. Okay, let's start with what is ALM and what is the purpose of ALM? Well, ALM has 3 primary roles. One is a service provider, a liquidity provider, and an investment manager. Let me explain what they are. Service provider is to manage the mismatch and risks associated with liquidity and interest rate risks on the banking book. This ensures that the balance sheets balances and ALM receives them in the range of currencies and various currencies and tenors. They also warehouse standby liquidity for funding longer term assets. They advise ALCO and senior management on liquidity conditions and balance sheet matters. And to prudently manage the group's liquidity and regulatory statutory reserves portfolio, this is primary role for ALM from a liquidity perspective. They also ensure that stress tests and ratio requirements for regulators are also met. And the other sort of contentious issue they deal with is the fund transfer pricing, where they try to price in the money correctly based on supply and demand. Liquidity provider, what we mean by liquidity provider is to raise and deploy funds in the wholesale and interbank market, both secured and unsecured. So they work closely with the various front office functions to identify what the liquidity requirements are for the financial institutes, and thereby providing a strategic plan to be executed to raise those liquidity. Investment manager function is to generate P&L by expressing the views around risks in the banking book. ALM is primarily concerned with only the banking book. I mean, trading book is not the remit of ALM. It's more the remit of market risk. So the P&L movement and generating P&L is focused totally on the banking book. Moving on to what the different risks covered by ALM are, is that it's liquidity risk, interest rate risk, credit risk, operational risk, solvency risk, and currency risk. As you may be aware, market risk is usually concerned, again, as I said earlier, with trading book interest rate risk, currency risk, and a small amount of credit risk. But as you can see, ALM covers all risk types because liquidity needs to be provided for all the risk types, albeit on the banking book. So in one form or another, all of these risk types are touched upon by ALM. On the next slide, I'm trying to explain what the primary goal of ALM is. ALM is a sort of a strategic view for the financial institutes. It ensures that the shareholders' value and the net interest income are optimized and remain stable and positive under all possible interest rate scenarios and liquidity scenarios. Basically, the ALM function gives the confidence for senior management via the ALCO, Asset and Liability Committee, to ensure that the bank or the financial institute is managing liquidity effectively. The ALCO is usually a monthly meeting, and it's attended by the senior management across the FIs, and is usually chaired by the CFO or the CEO. Now moving on to liquidity risk. Liquidity risk is defined as a potential loss due to the bank's inability to meet its cash flow obligations at a reasonable cost. That's the key, the reasonable cost. So they need to look at how much does it cost to repay the deposits, how much is provided from committed funds, and what payments on off-balance sheet items is provided, and how much of the off-balance sheet items do we need to provide for. So it becomes a very paramount that you have to have a good understanding of the balance sheet if you're working in the ALM area. And one of the sort of a good phrases which I saw before the financial crisis of 2007 was that whenever anybody mentioned liquidity when the market was good, people didn't focus on liquidity as much. But one of my supervisors, he actually said that think of liquidity as like oxygen. You don't feel it when it's there, but when it's gone, you definitely choke on it. Moving on to how does liquidity risk arise? Now, imagine you have a 3-year asset funded out of a 3-month deposit, as you can see in the graph there. The liquidity risk is that you got an asset which is maturing in 3 years, but you're funding it with a 3-month deposit. So you take the deposit now, and in 3 months' time, what happens if the deposit cannot be rolled over? How is the asset going to be funded for the remainder of the term? That is liquidity risk. And that is also known as asset liability mismatch, which ALM focuses on trying to eradicate. But this is a very simple example. As you can imagine, in the large financial institutes, large banks, there are many assets and liabilities, so the task of ensuring that assets are funded is critical. So next question is, why is liquidity important? Liquidity, as most of you would have heard in especially over the last few years, the catchphrase is that liquidity is king, and all banks have been holding liquidity, especially during the recent financial crisis. So the question is, why is liquidity important? If you have insufficient liquidity, it can lead to failure of not being able to meet your demands in terms of for your depositors. And also, any shortage of liquidity will lead to a run on the bank, basically people queuing up to take the money out, which will incur huge losses and potentially lead to insolvency, as we've seen with Lehman's and various other financial institutes in the recent past. But on the flip side, if you have excess liquidity, that's also a problem, because what happens is you have there is a huge cost involved in raising liquidity. So you don't want to hold liquidity and sit on excess liquidity. It just means that you're going to be missing out on any future profitable opportunities. And also, if you're going to raise liquidity, you're going to be and you're not utilizing it. It's just inefficient, an inefficient use of the capital and inefficient use of the balance sheet. And in this financial climate, if you are sitting on a lot of liquidity and if you're liquidity rich, you are a prime target for takeover, because there's a lot of financial institutes who are very thin on liquidity, and they're looking for liquidity rich banks to take over. So anytime you're riding on a large liquidity buffer, you better have a strategic plan to be utilizing that liquidity buffer, or you're likely to have a bid made against you. Moving on to what are the primary principles of liquidity risk management. The principles for sound liquidity management was defined in the Basel document under BCBS 144, from which Basel III liquidity metrics and the management was derived. Firstly, you need clear articulation of liquidity risk tolerance and senior management review. What we mean by that is you need to have specific metrics you measure liquidity against, and you monitor it stringently. And that metric needs to be reviewed at a senior management level to set limits. And any breaches of those limits, there needs to be escalation process and needs to be managed properly and in a timely manner. You need to incorporate the cost of raising the liquidity, and that is usually done through the funds transfer pricing. And you need to have an effective process of how much does it cost to raise liquidity from the interbank market, and that cost has to be relayed back into your funding desks, through your funding desks to your trading desks, or whoever needs the liquidity, whoever needs the cash. And obviously, you don't want any concentration risk on your books in terms of currency, product, or market. So you need to diversify the sources and tenor of funding. Effective intraday liquidity and collateral management is paramount. you may have liquidity coming in, but if you're short during the day, you're going to get caught out. So intraday liquidity management is extremely important, because a lot of the derivatives contract you have to settle on the day, especially exchange traded contracts, you have to settle on the day, and you have to have enough liquidity to cover those positions. Stress testing and contingency funding, it is extremely critical that you understand your liquidity requirements under stress. So, and you prepare a contingency plan for such scenarios. Under Basel III, this has become a paramount issue. Identification, measurement, monitoring, and controlling of liquidity risk. As I said, you need to firstly identify what metrics you want to measure, and you need to measure it accurately and monitor it on a daily basis, or even more, like even during the day, like intraday. And you need to control your liquidity risk, and you need to have your liquidity within your liquidity risk appetite. And you need to understand the interaction between liquidity and other risks, especially market and credit risk. The risk is it's not in silo. It's all sort of coming together. There's a lot of sharing of information between the different risk types. So you need to be aware of all of the overlaps between the different different types of risks. Now, primarily there are two types of risk, two types of liquidity risk. First is called the funding risk, and secondly is the trading risk. Funding risk primarily refers to the banking book risk, and trading risk refers to the trading book risk. So under funding risk, what we mean is that it's the inability to meet contractual obligations when it's due. That is a primary concern for funding risk. So you have an obligation and you don't have enough liquidity in your books to be able to meet. That causes, that leads to insolvency. That's the end goal, but it causes a lot of other issues in between. And also, funding risk it increases the inability to grow the business, primarily due to large funding mismatches in the balance sheet, and also inability to manage the cash flow positions. And it also leads to holding illiquid assets and investments. So if you hold a lot of illiquid assets and you can't turn the liquidity, those assets into physical cash or into liquid assets, then under stress, you're not going to have enough liquidity to survive. We'll be touching on this point later in the presentation under Basel III. Under trading risk, what we mean is that it's the inability to liquidate price positions without causing significant changes in price or attracting attention or compromising on credit quality. So in the financial markets, if you're seen to have a shortage of liquidity, obviously the cost of, when you go into the market to raise liquidity, the cost will increase significantly. You don't want to do that. You don't want to be in a position to be having to do that. So you want to make sure that the price you're paying for your liquidity is maintained at a reasonable rate, and it doesn't go out of hand. This usually happens due to, again, illiquid instruments or markets, liquidity grinding down in the market, or abnormally large positions. If the bank takes a large position, large asset, without thinking through the liquidity aspect of it, how they're going to fund that asset, that's going to lead to a lot of liquidity risks. Now, let's move on to what Basel III is all about. So, the first question is really, why did Basel Committee develop the new accord? Any ideas? Please put your comments in the question box or on the chat windows. It's primarily because in 2007, 2008, during the financial crisis, many of the financial institutes failed due to lack of liquidity, not due to undercapitalization. So what Basel III tried to address was exactly that, trying to force banks to hold proper liquidity as liquid assets and also to manage liquidity in an effective way. Because under Basel II, liquidity risk was never addressed. Basel II was more concerned about credit, market, and operational risk. And liquidity risk, there was never really a requirements to monitor liquidity same restricted way as you were monitoring market risk through VaR or credit risk through IRB models. So Basel III was developed. Now, the objectives of Basel III is really threefold. Firstly, the regulations for capital and liquidity needed to be strengthened to promote a more resiliency in the banking sector. Secondly, you needed to improve the banking sector's ability to absorb shocks arising from stress. And finally, Basel III introduced new liquidity standards and major changes in capital regulations to address systemic risk. So under Basel III, there was a lot of requirements for liquidity. They basically introduced two liquidity metrics, which we'll go on to talk about. But also there's a raft of requirements to manage capital more effectively. And they also brought in a number of new capital buffers. But unfortunately, we don't have time to cross that in this webinar. Okay, now let's move on to what is covered under liquidity under Basel III. Primarily, there are two key metrics. Firstly, the liquidity coverage ratio, and secondly, the net stable funding ratio. And this slide provides a summary of what these two metrics are really about, what the objectives of these metrics are. Okay, let's take LCR for a start. LCR is a measure of short-term liquidity or short-term liquidity risk. It ensures that the bank has sufficient liquid assets to survive a short-term stress. And they agreed on a 30-day stress scenario. It also ensures that you have sufficient liquid assets to survive those 30 days. So the implementation date for LCR is that we're starting with the observation period was from 1st of Jan 2011. Sorry, 1st of Jan 2011, and the implementation is going to be stagnated, starting with 60% compliant in 2015 and being 100% compliant by 2018. Now, NSFR, or net stable funding ratio, is more about a measure of a medium to long-term liquidity risk. So what Basel III realized, what the regulators realized, is that there are two types of liquidity risk. One, to make you survive, make the financial institute, the bank, to survive a short-term financial crisis, and also to ensure that there is stability in the economy in terms of in the financial markets, that you don't have shortage of liquidity. So they're ensuring that the banks hold enough medium to long-term liquidity as well. So NSFR establishes a minimum acceptable amount of stable funding based on certain characteristics of the liquid assets. This, again, as I said, this is to ensure that banks' behavior over long-term assets are funded with the minimum amount of behavioral long-term liabilities. So, thereby, what we're basically saying is that, any bank who does long-term, funds long-term assets need to ensure that they have good, stable funding to fund those assets. The amount of equity and liability financing expected to be reliable sources of funds over 1 year. What we're saying there is that the equity and liability, you need to make sure that those sources of funds are reliable for at least 1 year, i.e. you can count on those for 1 year period. These two ratios provide a clear view for investors and customers on the decline in profitability or solvency of a financial institute, and it also gives you an idea of what the reputation or the credit quality of the bank is. Again, the implementation for NSFR currently is 1st Jan 2018, and there is still a lot of as you know, Basel III is still not finalized, so there may be some changes to the definitions of NSFR in terms of what we consider as stable funding and what we consider as required stable funding. So that is still up for debate, and it's still currently being worked through by the regulators. Moving on to LCR specifically, and let's look at LCR in more detail. Now, under LCR, or to comply with LCR, banks must hold a stock of unencumbered high-quality liquid assets. Now, what do we mean by high-quality liquid assets? Let me come on to that a little later, and it's to do with the quality of the asset. I'll come to that in a little while. The next is the net cash outflow for the 30 days, because we said that LCR is compliant for the 30-day period. It needs to be prescribed under a certain stress scenario, and I'll define what the stress applied or the stresses are. And the bank should periodically monetize portion of the assets in its liquid assets buffer to a repo or an outright sale to the market. This is to test the access to the market, the effectiveness liquidation process within the bank, and the usability of the assets, and to minimize the risk of negative signals during the stress. Now, what happened during the financial crisis was that traditionally a lot of the financial banks rely on repo for short-term liquidity. Now, what happened during 2007, late 2007 and early 2008 was that the repo market dried up. So a lot of banks were holding CDs, commercial deposits or commercial papers, but they couldn't exchange it for cash. And they can't do anything with the CD. I mean, the only thing they can do it is, for short-term liquidity, they need to be able to sell it in the market somewhere. But nobody was willing to buy it. That's when the central banks intervene and pump money into, to get people lending again and get the repo market up and running again. So under Basel III, that's why the reliance on HQLA and also forcing banks to check if their liquid assets are actually liquid is very important. And the second issue with HQLA is that the price risk of HQLA may be hedged but cannot be used for hedging. So the interest rate risk on the HQLA can be hedged, but HQLA, the high quality liquid assets, cannot be used as a hedging instrument. And it cannot be used as a credit enhancements for structural transactions, and it cannot cover operational costs as well. It should primarily be just for liquid assets, held as liquid assets. LCR is to be reported in a common currency depending on your location and the currency, the prominent currency for the bank. But banks should be able to use the stock to generate liquidity in the desired currency and in the jurisdiction in which the liquidity will be required. Which means that if you're sitting in Singapore and you're holding US dollar, it's no good. I mean, you need to be able to monetize that into Singapore dollar. So you need to make sure that you hold enough Singapore dollar to cover your liquidity positions in Singapore. Banks are expected to be able to meet their regulatory needs in each currency and maintain high quality liquid assets consistent with the distribution of their liquidity needs by currency. So all the major currencies, you need to be, any large currencies, you need to ensure that you have enough liquidity in those currencies for each of the jurisdictions the bank is operating in. Which means if you're sitting in UK, you need to make sure that you have sterling, and if you're in US, you need to ensure that you have enough US dollar. As I said, the net cash outflow is based on 30-day stress. Well, the stress which is applied under Basel III is a combination of an idiosyncratic and market-wide shock, which results in a runoff for a portion of the retail deposits, the losses of unsecured wholesale funding capacity, and then there's a loss of short-term financing with certain collateral and counterparties. And one of the other scenarios is contrived is that if there is a 3-notch downgrade of the bank on top, in addition to the contractual outflows. This increases the market volatility and impacts the collateral and future exposure of derivatives. So you need to make sure that you take account of that. And also you need to take account of unusual, unscheduled drawdowns on committed facilities, which have not been currently used. And you need to also mitigate reputational risk by buying back debt to honor non-contractual obligations. So all of these risks, all of these scenarios are combined into a Basel III stress scenario. And then from that, you generate what your 30-day cash outflow is going to be. Okay. Like I said earlier, HQLA it refers to high quality liquid assets. HQLA is primarily divided into two, level 1 and level 2 assets. Level 1 refers to the highest quality liquid assets, and there is no limit to holding these assets for LCR. The characteristics for HQLA, or for any assets to be considered as HQLA, is that you need to have low credit and market risk. The asset has to be well diversified, and there has to be ease of, you need to be able to value it at any point in time. And there needs to be a low correlation with risky assets. And the HQLA has to be eligible for central bank, intraday liquidity, and overnight facilities as well. And they also have to be reliable sources of liquidity in the market, either through a repo or through sale, even under stress. And Basel III has gone even one step further, saying that even under stress, the price of the liquid asset should not drop, the price should not increase by more than 20% over the 30-day period. And obviously, the asset has to trade in a large, deep, and active repo and cash market with low level of concentration. And importantly, HQLA cannot be issued by the financial institute or subsidiary. So bank paper is excluded. But like I said, different levels of HQLA are primarily determined by the type of product and by ratings. Level 1 is the highest, and the products which can contribute to level 1 is cash, physical cash, central bank reserves, marketable securities backed by sovereigns and central banks. And level 2 is further subdivided by rating, and it's level 2A and level 2B. Level 2A is primarily government securities and covered bonds and corporate debt securities with at least AA minus rating. And level 2B includes the lower rated corporate bonds, RMBS, residential mortgage-backed securities, and common equity. But the RMBS have to be rated higher than AA. The underlying caveat for all of this is that you cannot hold, well, level 1 assets may not, in total of your liquid assets, level 1 cannot be greater than 40% of your HQLA. Level 2 may not account for greater than, level 1 assets may not in aggregate account for less than 40% of your HQLA. So of your whole total HQLA, minimum 40% has to be level 1. Of the remainder, level 2 cannot be greater than 40%. And level 2B cannot be greater than 15%. So what they're basically forcing you to do is to ensure that you have high quality liquid assets under level 1, which will primarily be the ones which will save you under stress or save any bank under stress. Now moving on to the next slide, which is looking at the numerator, net 30-day cash flow. The table shows a composition of the cash inflow and the cash outflow. Now, what do we mean by net cash outflow under stress over 30 days? It actually means what your cumulative expected cash outflow is, subtracted by net cumulative expected cash inflow. So it's your cash outflow minus your cash inflow. The cumulative cash outflow includes your outstanding balances of your liabilities and off-balance sheet commitments, as well as your expected roll-off or drawdown. The cumulative cash inflows includes is for the outstanding balances of contractual receivables and the percentage that reflects the expected inflow under stress. So the combination of the two will give you your total cash inflows. Now the total cash inflows are capped at 70% of total expected cash flows, thereby ensuring a minimum level of HQLA are held at all times. So what the regulators are basically saying is that the HQLA is your primary saver, is what is going to bail you out of any stress. So your cash inflows need to be at, your cash outflow needs to be at least 25% greater than your cash inflow. And LCR is currently defined to be reported monthly, but if there is a stress, regulators have the authority to move LCR to be reported daily. And LCR is to be disclosed as part of Basel Pillar 3 disclosure. Now, there are two different types of LCR. I mean, if you have a multinational organization, you will, or if you have multiple regulators, you will have a group compliance, and you will also have a national compliance. Now, each individual regulators in each individual country are defining how the Basel III regulations need to be translated for their country. So for India, RBI are working on it, for Singapore, MAS are working on it, and in UK, PRA are working on that. They will come out with their own individual regulations, which will be what will be managed by the financial institutes. Now moving on to NSFR. If you remember the previous equation here, NSFR is primarily, the equation is that, available amount of stable funding divided by the required amount of stable funding, and that has to be equal or greater to 100%. Now, what do we mean by available stable funding? Available stable funding is, it's primarily Tier 1 and Tier 2 capital. It's preferred stock of liquidity, and not included in Tier 1. Secured and unsecured liabilities with 1 year maturity or greater. Non-maturity deposits and term deposits which have maturity of less than 1 year and which are expected to stay within the bank for even during stress. Unsecured wholesale funding with maturity of less than 1 year, again, which is expected to stay within the bank under stress. So these are all considered as available stable funding. The required stable funding is cash, short-term unsecured instruments and transactions less than 1 year, securities with no embedded option with maturity of less than 1 year, securities held with an offsetting reverse repo. You can see the list there. I'll just pick out a couple of more which are very, very important. Loan to banks with maturity of less than 1 year. Liquid assets with maturity of greater than 1 year. There are not many of those, but there are a few. RMBS, equity not issued by FI. So these are all considered as required stable funding. And again, with these classifications, it's not firmed up yet. So we're still working through regulators are still coming out with their final versions. We're still waiting for that. And so far, they've stated that NSFR, again, is to be disclosed under Pillar 3. The final version of Basel III is expected towards the end of this year, Q3, Q4 this year. That will dictate, will give the definitive answer on what the actual runoff rate is for LCR deposit cash flows, and how much HQLA we need to comply with. All of the final percentages will be finalized in the final version of Basel III. But the fundamental framework for Basel III is not going to change significantly. I think that's pretty much done. It's only the percentages which will change, and also maybe some slight differences in the products, but nothing significant. And again, the major challenge is to see how each individual countries will apply the Basel III regulation. How will Singapore interpret it, or how will India will interpret it? That is going to be interesting, or Hong Kong, for example, as well. And that ends the webinar. If you have any questions, please drop a note. There was just a question here where it will be established. It hasn't been established yet. We're still waiting for the final version of Basel III. It's still in draft form. We're getting close to the final version soon. Is there any other questions? How will bank MNC be regulated through Basel III? Again, it's through the national discretion. The individual countries' regulators will dictate. Depending on large MNCs, will depend on who your host, your home regulator is going to be, and the relationship between your home and your host. That has to be determined for the individual organizations. So if you're regulated from US, then your primary regulator is US, but you also have business in Hong Kong, then you'll have to report to if your group is represented from US, then you'll be regulated by the US as a group, but also have an obligation to meet the local regulators if you're sitting in Hong Kong. So there'll be two sets of reporting. There may be slightly, well, there will be difference, but then that difference may not be very significant. Any other questions? If there are no other questions, then
there are a few, Senthil. Hi, Senthil. Hi, everyone. There are a few questions coming in right now. One is, are there any other risk factors included in Basel III? So, would you like to answer that?
Sorry, say that again, Ashu. I didn't quite catch you.
Are there any other risk factors included in Basel III?
Oh, under Basel III, yes. I mean, I only talked about the liquidity portion, but the other portion is really capital, solvency risk. There is a whole heap of capital buffers coming in. If you remember, Basel II was primarily dealing with economic, trying to work out the market risk capital, credit risk capital, and operational risk capital, and leading to economic capital loss. Under Basel III, it's taking that next step further and incorporating capital buffers for various factors. Again, I mean, that's a separate webinar in itself. I mean, we can't combine the two. It's just far too big. And the capital requirements or compliance for capital is a little, in terms of timeline, it's a little further away. It's more 2018 to 2020 is the kind of the timelines we're looking at. So the focus is, for all banks, the focus is really on the liquidity now, because it's really 2015. We're about a year away, year and a half away.
Right. There's another question that's coming in from Kalyan. He asks, what are the main difficulties that Indian banks will face in implementing Basel III, if any? So what are your views on that?
Yeah, the main problem with Indian banks is going to be, how are you going to classify the HQLA? In terms of liquidity anyway, how are you going to comply with the requirements that you have high quality liquid assets? Because there is, as I described, the content of HQLA is split into level 1, level 2A, and level 2B, and they are all very highly rated assets. And there's going to be a huge competition on getting those liquid assets on your books. So how is the government or RBI going to manage that? Still not clear. And also an interesting question is, under stress, if I hold a lot of liquid assets, say government securities, which is considered as level 1 assets, when I go to economic stress, idiosyncratic stress, systemic risk, what is it going to be the value of my government security that a single bank holds against somebody else? Say, what is the value of a liquid asset held by ICCI against Yes Bank, for example? How would that work? Would they be at the same level? You're still not clear on that.
Yeah, I believe that must be quite clear for Kalyan. If he has any doubts, I'm sure he'll type in the now. There are a few other questions. So Ashwin Iyer is asking, is there a process or guidelines for the cash flow modeling? And Subrata is asking, will you suggest the manufacturing/service companies also follow business Basel III standard? Will it be suggested that either of these sector companies also follow Basel III standard?
No, the Basel III is primarily for financial institutes. It's not really for manufacturing. But it is prudent to make sure that if you're in a manufacturing industry, that you have access to liquidity.
And so what are the guidelines for cash flow modeling for the same?
There isn't really any guidelines for cash flow modeling per se. Basel III only dictates what the cash flows are. But how you model that is, there are many ways that you can do it. You just pick up any ALM module, ALM text, and they'll tell you how to model cash flows.
Okay, I'll just go through the questions asked previously. Kunal Bhalarao wants to ask, suppose some country's monetary bank is implementing the Basel III differently from most of the other countries. How would it impact counterparties who are doing business, the bank in their countries, doing business with the bank?
Right. There is going to be a huge synergy in terms of Basel III implementation at a country level. All regulators are speaking to each other, and there is not going to be hugely large differences between one country to another country. And the Basel Committee in Switzerland, they're absolutely aware of the issue and taking extra steps to make sure that all countries have at least a good base. The differences are going to be more in terms of how you the kind of instruments you can go into HQLA for in terms of liquidity, or what the the different runoff rates under stress is going to be. But there is no huge, large differences. So from a counterparty perspective, there should be no impact or very little impact for that.
Right. When you're speaking of HQLA, Martin Weeks wants to ask whether HQLA levels says securities backed by sovereign. So would a policy bank backed by sovereign count? Example, Exim Bank in Korea. So I didn't really get the question, but is it somewhat clear to you?
Yes. I mean, that is again at the discretion of the Korean regulators.
There's another question.
How Korea is going to implement Basel III, it will determine that.
Right, I'm pretty sure that would be another webinar altogether. Sure. There's a question that Soumya has asked. She says, who regulates liquidity cutoff? Is it national or the group?
It depends on your organization. Firstly, if it's an MNC and you have multiple countries, and your primary regulator will determine what your liquidity cutoff is, but also you will have an obligation to meet with your national discretion on reporting your liquidity as well. You'll have to do both.
Oh, okay. Then there's another one that Abdul asked. Is it value of gold loans or the security value?
Sorry, the value of gold, is it?
Yeah, he's asking, is it value of gold loans or the security value? I'm not too sure what he's referring to here. Okay.
Yeah, it'll be security, gold securities, not physical gold.
Okay. Well, if anyone has any other questions, they might ask here. Okay, there's Rizwan asking, banks are currently moving more in government securities to decrease their risk. So will Basel III be helpful in this context?
Absolutely. I mean, if you look at the level 1 and level 2, the focus is primarily on level 1. One of the things which has, under level 2, for example, you can hold corporate debt, but one thing I didn't mention there was that there is a large haircut applied on level 2 securities. So to the extent that, if you have, the haircuts can be anything from 15% to 40% for corporate debt under level 2. So it is in your interest to hold more government securities.
Right, and Abdul, the previous
is definitely pushing towards it.
Right. Abdul in his previous question was referring to under required funding resources. So if that makes it a little clearer, I'm guessing in any case Senthil has answered that question. Sudhanshu has an interesting question here. Whenever we're in meetings, my bosses talk about duration of equity and market value of equity. What exactly are these is what he wants to know.
That's a market risk question. It's basically to do with bond duration. Time value of the bond as it goes through the timeline, as it approaches maturity.
Right. So could you just elaborate on that a little, citing the difference in the two so that it becomes a little clear for Sudhanshu?
Okay. Basically, what happens is when you look at the bond or a equity profile, it's generally not, you don't have a linear relationship. You have a sort of an exponential relationship, reverse exponential relationship. So as you approach maturity, you will tend to lose, the value of the bond decreases more rapidly. So you want to make sure that from a bank's perspective that you terminate the contract not too early so that you miss out, and also or not to hold it, especially if it's a trading book security, that you don't want to hold it to maturity, because again, you don't get the best rates.
Okay, so I believe Sudhanshu, now next time in the meetings it will be clear for you. Next question is from Natrajan. He says, the ratings of asset or instruments may vary based on rating agency. Are there any standard ratings to based for clarifying the assets?
Right, Basel III states that the ratings to be used are consistent with what the ratings have been used for Basel II. So whatever you have used for rating, for credit rating, for credit risk in Basel II, you use the same rating for Basel III. But at national level, I'm not sure if they're going to change significantly from that. So Basel is saying that from a rating perspective, you use whatever you use for Basel II. So if you did everything from Moody's, then you use Moody's. If your rating agency for your credit for all your securities was primarily S&P, then you use S&P and so on.
Okay, that's pretty explanatory. Kunal has another question. There have been debate earlier that financial institution is going to use swap rate, a means to assess the riskiness of financial instruments, and do away with using ratings provided by third-party rating agency. Is any provision for that in Basel III?
No, it doesn't come into Basel III at all. That is those are all sort of academic exercises outside the regulatory world which is happening. I mean, there's also talking about, there's also talks of liquidity swaps to reduce your holding of high quality liquid assets, but none of that is covered under Basel III.
Okay, I believe that should be pretty explanatory, Kunal. I hope your doubt has been cleared. If there are any other doubts, you may either raise hands or write a question in the question box on your right-hand side panel. Thank you, Rizwan, for appreciating the session. He says, good session, thank you.
No problem. Well, if that's all, if there are no further questions.
No, Kunal and Ashwin, Kunal has one more question, I believe. He might take some time to type it.
Sure.
We'll just wait around for you, Kunal. Are the internal ratings going to be used in haircut calculation in Basel III, is what Kunal asks.
Sorry, the internal ratings? Sorry, say that again, Yashin.
Are the internal ratings going to be used in haircut calculation in Basel III?
Interesting question. Internal ratings. If you used internal ratings to comply with Basel II for your credit rating, for rating your credit for credit risk, then they can be applied for Basel III. But again, that you need to have approval from your local regulator.
Okay.
You may need to do a mapping of your local or your internal rating against your S&P and your external rating agencies.
I believe that should be explanatory, and Kunal says thank you. Okay, he's got it. I believe that brings us to the end of the session, a very well informative and very well answered question. So thank you, Senthil, for giving us your time. And if there are any doubts, you can still contact us at help@EduPristine or drop me a mail at yashu@eneev, that's ENEEV.com. Thank you. Thank you, everyone. Oh, wait, there's one more question from Kulbir Singh. He says, under Basel II or III, what is the status of Indian banks under advanced approach for market risk, credit risk, etc.?
I'm sorry, but I'm not aware of the Indian market or the Indian Indian requirements for Basel II compliance. I'm a little way away from that, so I'm sorry I can't answer that right now.
Okay, I'm sorry, Kulbir. That's probably, we'll get back to you on that question. You can simply.
Sure. Let me have a look at it.
Oh, Kulbir wants to ask, what about the international context?
From an international context, yeah, Basel III is going to be again determined from your local regulators, and whatever you have applied for. Well, the liquidity portion is new. I mean, there is nothing in Basel II, so this is all new. But from a capital portion, there is an overlap from Basel II. It's sort of Basel III is sort of an add-on from Basel II, really. It's looking at different aspects of capital usage. So you need to ensure that IRB models are compliant and ratified by your regulators. But what they're insisting on in Basel III is, I mean, what the regulators realized is that when you allowed banks to comply with IRB models, they develop their IRB models and get those ratified by the regulators. The IRB models were not very accurate under stress, and even under the systemic risk, the financial crisis, people realized that the IRB models were not that effective. So now Basel Committee has gone backwards and said, look, we're not going to give you the discretion of you developing your own internal models. We're going to dictate what you need to do. So if anything, this is rolling back more towards Basel I, where under Basel I it was very prescriptive. You have, this is the ratio. You have these assets, this is the haircut you apply to it, and this is how much capital you need to hold against it. We're kind of moving, it's somewhere in between the two now.
Okay, I believe that should be, yeah, that should be a pretty explanatory answer, Kulbir. He says, thank you, Senthil. Okay, so that does bring us to the end of this session. If you have any other doubts, our in-house experts would be available to clear all your doubts. So just drop in a mail to help@edupristine.com, or you can drop me a mail at yashu@eneve.com. Thank you, everyone. Thank you for attending this webinar.
Thank you.